All right. Good afternoon, everyone. Sorry for the little bit of a delayed start here, but I'm really excited to kick this webinar off. My name is Peter Kincaid. I'm the CEO of Raintree Financial Solutions. I'm joined today by Jason Jogia, who's the Chief Investment Officer of the Avenue Core Trust. Did I get that right, Jason?
That's correct.
Amazing. Jason, so welcome, and let's kick off the presentation.
So, thank you. Let me cue this up now. So, Avenue Living Core Trust, open-ended real estate vehicle that was established back in 2017, and Raintree, our inaugural investor when we set this up back then. Really a multifamily owner-operator that has a track record since 2006. The disclaimer statement here, pretty standard fare. Our overview of our platform today is a $1.6 billion assets under management with a 14-year track record. We have exposure in 19 different markets, and really have 5 different mandates. Broadly speaking, the Core Trust is one of our mandates. I serve as the Chief Investment Officer of all of our mandates. That includes our mini mall storage. It includes our Avenue Living Core Trust, our Opportunities Trust, our Ag Trust, which is on the shelf of Raintree, as well as our US fund that is just launching later in 2020. We have a pretty robust platform of managers here, both asset managers and property managers, with over 450 staff to date. We currently are the custodians of $550 million in equity. And really broadly, when we say 3 strategies, we say commercial, land, and residential. One of the interesting things about our platform is that we truly do have a lot of money invested in by our founders, with $250 million in equity by them and their families across the platforms. I just mentioned these 3 strategies. Today, we're really going to focus on the Core Trust and how it performed during the COVID crisis, and just kind of some of the big KPIs that are there. What's really interesting is this history curve of the company. Since 2006 to 2019, during this journey, we've really grown from a very humble beginning. And, I think it's important to remind everybody of how we pick our markets and what type of assets we pick and why it's important. We are the workforce housing specialists in Canada. We buy low density real estate that's typically somewhere between 30 units to no more than 100, townhouse, low rise walk-ups, and essentially the tenant populace that are there are what we call the essential workforce. They're the workforce that are the rent by necessity, not necessarily rent by choice. They're not affordable housing tenants, but they will not be looking for purchasing options. They look for renting options that are quality and sound. The markets that we were in, I mentioned that we're in 19 different markets, are all across the prairies. And I think I might have a map here. I'll come back to it. Really, where within the prairies, we service both the primary markets of Calgary, Edmonton, Saskatoon, Regina, and really focus in on some of the secondary and tertiary, so trading hubs as we call it. If you look at the prairies as a whole, there's about 6 million people within the 3 provinces, but servicing an area that's almost the size of Europe. And as a result of that, what we lack in population density, we have to make up in infrastructure. So when we bought our first asset in Brooks, Alberta in 2006, 24 doors, we were focused really heavily on the tenets of what makes Brooks tick. And what we learned really quickly is that was a very sticky town that has now to this day stood up to 3 different recessions, continues to have a growing population and a huge service sector to service the trading hub multiple in and around it of approximately 3 times its local populace. And so by focusing in on these markets and that asset type and that demographic, what we've been able to do over the course of our history is build our platform very successfully. As I mentioned, our depth of platform includes a vertically integrated management process. So what we've learned in our history is that by outsourcing management, you tend to lose a lot of the value proposition that's offered. And so by us insourcing not just our property management or in-field work, but our in-house work such as legal or accounting or CapEx, we create a lot of value in the value chain of how we service our buildings and how we service our residents. And that's really proven to be very successful and fruitful during times of COVID, where, ultimately for us to navigate these times, we needed to provide services to our 20,000 residents. But if we didn't have a vertically integrated platform, we wouldn't have been able to get a third-party property manager comfortable with continuing to work there. We doubled up on our PP&E. We took extra measures to make sure that our residents were safe and our staff were safe. But in absence of a vertically integrated platform, it's very difficult or challenging to implement that service standard. Just so everybody's level set, the core trust here just our KPIs in terms of the terms and structures. A bit more of our history and how we've grown the business. So really, ultimately, we are started in 2006, built this business through 3 different crises: global financial crisis, the commodity crisis, and COVID-19. What we find very interesting with what we've accomplished here is that, COVID recession as a backdrop is just another recession for us. We've built this business and bootstrapped it through the dark turns of various dark times. And ultimately what we found in our business is that the growth curve tends to happen during crisis. So it's a really exciting time for us in that, going through an entire quarter and performing and then getting into Q2 and getting through an entire quarter of COVID and having great, strong KPIs have been very, very beneficial. Just some case studies on some of our assets here. So I'm just going to go try to find my slide on COVID. And Peter, I apologize. The COVID slide's not in here. So why don't we keep going? Sorry, give me 1 second. Yeah, so what I will do is just kind of give you the high level of what our Q2 results have been for Avenue Living during COVID, and really just focus in on some of the things that we've done during this time and how that's translated into our performance. So first of all, as we started into the COVID embarkment, we did double up on our PP&E. We did double up on our protocols of cleaning and our ability to service our residents. It was definitely a time where command and control of the business was important. The biggest concern that we had going into COVID back in March was surrounding the collections. And as a result, we set up our community task force and our prairie relief team, which went out on a proactive basis and ultimately went and worked with our residents to make sure that if they were going to face financial hardship, how could we help? And what we ultimately ended up doing is working with our residents to set them up on government payments, getting them register the program where needed, offering things like weekly payments. And really it was this proactive nature and the voluntary nature of our employees, where 50 people volunteered to be part of the task force, enabled us to gain command and control of our business through March, into April, into May, and into June. And what I'm really proud to say is that our collections ultimately ended up being over 97% for our Q2 period. So an entire period in COVID where collections ended up actually increasing quarter over quarter based on our microscopic look on it. We continue to work with our various government stakeholders to ensure that we're well informed in changes to public policy, but we have our lines open to our residents should they need any additional support. In terms of leasing, by us being very proactive, having available inventory, we just finished a major renovation. As you can see in the slide here, our value creation project has occurred over the course of the last 6 quarters. We had a lot of available inventory that were allowing us to take a lot of leasing volume. Our leasing activity during COVID, and coming back to the flight to affordability, increased substantially. We were up about 55% in volume quarter over quarter. And ultimately, we saw the occupancy of our platform uptick during the quarter to over 90% versus the 88% we had in Q1 2020. It was a very exciting time for us because in light of COVID, we did see ourselves continue to have financial performance. Renewals was another piece where people were really keen to stay in place or shelter in place. What we saw is in the quarter, our average retention rate was well over 75%, moderately above our Q1, which during the winter season, we tend to see people above looking to renew at a higher propensity than they want to move in the summer months. But we really did see a strong fundamental there. What's really interesting is that the combination of renewals and leases led to a stronger occupancy in the quarter, and we really, going into it, we're not quite sure where we would end up. So with higher collections and higher occupancy and rental rates, albeit mandated not to increase by the province, holding steady, we were able to increase our revenue during the period. In terms of how we service our residents, things like work orders and CapEx that are being done in the building, we took a very pragmatic approach during the quarter. We were very, very cautious in deploying capital and making sure that we were not, overspending or over allocating our capital, ensuring that we had ample liquidity to survive any sort of protracted recession. This is our third time to the recession movie, so we knew exactly what to do in this situation. But we were pleased to continue to offer, a service standard to our tenants where their work orders were being serviced within our 72-hour time frame, and that our outstanding work orders were well below our 3% target. We continue to bring suites online, and while we did slow down the bus of capital expenditures during the quarter, we started to commence them towards the latter end of the quarter as we started to see ourselves through the peak of the COVID crisis. In terms of a work from home routine, as you probably saw, I'm sitting in the office today. Gabe's in the office here with me. We're at about 85% capacity here in the office right now. At the peak of COVID, we were down to about 35%, and we successfully set up work from home for a majority of our employees. As a result, to this day, our call center still is working from home and are very pleased to say that they maintain a service rate of 98.5%. In terms of financial metrics, at the end of Q2, we acquired 231 doors. Those doors were in Edmonton, Red Deer, and Lloydminster, purchase price of $24.8 million, average price for door of 107. So when we entered into COVID, we had approximately 230 doors that we bought in Q1, another 600 doors to close by the end of the March. What we determined was the best prudent thing to do was to hold on to our cash, defer those closes, and watch and see what would happen, because we at that time needed to take the right steps as management. Ultimately, what we ended up doing is increasing our cash balances and our liquidity availability, which was very prudent for us. And then as we started to see KPIs consistently deliver positive results, we opened up for acquisitions. Our liquidity continues to remain very healthy. We're currently at just over 60% loan to value, which is within the mandate of where we would like to be. Our relationships with our debt and equity holders continue to remain strong. We have not missed a payment yet. We have not requested any reliefs, and we continue to manage redemptions, which have not peaked at all during this time. And again, I mentioned that our liquidity remains strong. While we're mandated in a rent freeze, we did see some positive results to our revenue. Overall, revenue grew 2.7%, driven by same door performance, new acquisitions, and ancillary revenue growth. And overall, our revenue per owned door increased from $811 to $813, a moderate increase in spite of the rental freeze. That, combined with a very, very sharp focus on expense management and prudent capital spend, has led to some great operating expenditure reductions. So what we saw is our same store operating expenses went down by 4.1%, and our overall OPEX per door went down by 11.3%. The result of a very, very strong KPI in terms of retention, leasing, and rental rates, improved our revenue. Our prudent approach to OPEX improved our expenses, and that resulted in an increase in NOI quarter over quarter by 8.7%, a 4.2% same store NOI, and a same store operating margin increase by 2.1. Overall, and we ultimately had a great Q2 during the backdrop of COVID. We are feeling fairly bullish with the Q3 in terms of the fundamentals of the business. And that's just due to the fact that we're a vertically integrated platform that has run our business in command and control, set up the proper protocols, and we just focus on the fundamentals every single day. We are expecting to continue to see positive absorption on our new available inventory. We're deploying new capital strategically on acquisitions and CapEx, but we're ensuring that we maintain ample liquidity along the line. Our pipeline of opportunities remain very strong. We have continued relations with our government efforts, and we also have our Avenue Giving campaign, and I didn't mention too much on that, but Avenue Giving was a campaign launched early COVID where we set up a $100,000 donation to the food banks. We created a Prairie Relief event where 500 of our units were offered at a discounted rate with weekly payments and really targeting frontline essential workers. And we also had set up our community task force, as I had mentioned, where our field was stepping up and doing things such as making masks for people in the buildings, dropping off groceries, walking dogs. So we really pride ourselves on the success of that. So all in all, we continue to be very bullish on what's to come.
That's really great, Jason. Thanks for that. And we've got a question that's come in. I'd encourage anyone else who's in attendance. There's a Q&A box that you can type your questions in if you've got questions for Jason. The first question relates to just how do we get more information, a fact sheet, that sort of thing, and I'll address that one. In that case, please reach out to your private wealth advisor, and they'll put you or they'll provide that marketing information for you to get more in touch with the Avenue Living opportunity. Jason, just in terms of contextualizing the achievements that you've made organization. I mean, your firm, your company has grown rapidly over the last 15 years. Where does it go from here? I mean, where's the organization going? I know we've been through this uncertain period with COVID, and it'll continue to go on for a period of time moving forward. But let's sort of park that off to the side. What are you excited about in this segment of the market? What do you see as opportunities? Let's get a little more high level in terms of just what gets you jumping out of bed each day. I know you've done a wonderful job on COVID, but this organization's more than a great organization implementing its business continuity plan. It's an organization that's going places. So let's talk about that.
Yeah, thank you, Peter. And I do apologize for the technical difficulty of having the wrong deck in front of everybody at this time. I was presenting pages on something else that wasn't in front of me, so I do apologize for that. So look, I think that's a great question. I mean, we have grown from, in the last 5 years, from an entity that had just under 800 million in assets to an organization that's now officially over 1.7 billion. We've more than doubled our scale and scope. And what we've really realized is that as we've built the infrastructure and the scoping, we are poised for future growth. And what we are seeing in the landscapes of the territories that we operate in, and it's a wide territory that we operate in, is that Ma and Pa, which owns over 70% of the apartment universe, are looking for an exit. And typically, where I showed that curve, and happenstance that curve was in this presentation, where I showed that curve of recessions, that is typically the time where people kind of say, enough's enough, I'm ready to exit. And so we've identified over 6,000 doors that we could buy across all of our existing markets, and mostly in the primary markets in this go around, to really grow this animal to 15, 16,000 doors, which the scope that we've built would be able to service. So, we're completely paperless here as an example. That allows us to go out and buy another 3,000 doors without having to worry about the administration burden that goes with there. We have Yardi. Yardi is the program that we just implemented as our ERP. It's the gold standard in the real estate industry. It's what's being used by the biggest real estate companies in the world. We now have that. So we're really now growing into our functionality, if that makes sense. That's what really excites me. So that's a function of opportunity, capital, and continued performance.
Now, did I hear you say that you just bought some assets at just over $100,000 a door?
Absolutely. 107,000 a door.
Tell me about that. I mean, that seems incredibly cheap. What do you do with those types of properties? What kind of yields or cap rates or NOIs are those generating for you? I mean, that sounds pretty attractive to be able to
Yeah,
provide someone a home to live in that costs you $100,000 or thereabouts.
absolutely. So great question. Those assets were a segment of three different markets. We had Lloydminster in there, we had Edmonton, and we had Red Deer. On the average at 107,000, the assets in your backyard in Edmonton were about 130,000. The assets in Lloydminster were about 79,000, and Red Deer kind of fell in between. But ultimately, we're probably somewhere between 35 to 50% below replacement cost. We purchased these assets that were all over 90% occupied, that were well over a 6 cap of in-place income. So what we are really excited about with those assets is that there is very little to do to generate the yield and the returns that are available to us. And then where the asset plan comes in play is just really turning tenants, providing them institutional quality management at better rates as the business plan goes on.
And better rates means better rents?
Better rents for us.
For you, yeah. Okay, I just want to make that imminently
I'm always
clear.
thinking of it from my lens, but yes, better rates for us.
So, okay, well, that's great. Now, historically, or the history of this business is that you've been very focused on the prairies, particularly Alberta and Saskatchewan. Are there opportunities beyond Alberta and Saskatchewan that you're looking at? And you know, some people may say, well, the energy business is in the toilet, so you know this must have a devastating impact on your portfolio. That's obviously two questions, but maybe you can address both.
Yeah, so I think you know, the Avenue Living Core Trust continues to buy in the jurisdictions of Alberta, Saskatchewan. We have a lot more road to run within these markets. As I mentioned, you know, they're still very unconsolidated in terms of the asset class that we're looking for and that we target, that low density asset class. So we believe that we can continue to grow the next 5,000 to 6,000 doors right in our backyard. And why we like our backyard? Because we're very comfortable with the governments that we have here. We're very comfortable with the regulations around being a landlord. There's no rent control here. We know it. We know it very, very well. East and west of us, it's a little bit different of a landscape, and we don't think that, you know, we're in any position to go into markets that are already oversaturated with capital dollars. But part of the reason why we're starting to look south, and as I mentioned earlier in our presentation, we do have our Avenue Living US Trust that's being launched for latter 2020. And the idea is that we're looking in the US prairie, or the equivalent of the US prairie, the flyover states. So the future progression of this organization may be a story that kind of goes south as we continue to develop. But as far as we're concerned, there's just lots of road to run here. And then coming to the second part of your question about oil and gas, we are very selective in the markets we choose. So we have, in our history through 3 cycles now, never gone and correlated our asset pool to Fort McMurray or Grand Prairie or any single commodity. We've also always focused on markets that have resilience in its GDP. So when one goes down, others come up. They tend to be trading hubs. They're servicing a larger, greater community, whether that be the First Nations community, whether that be a larger agri community, whether there be military bases close by. We look for that type of thing and then try to find that balanced economy within the context of the greater Alberta story.
Yeah, that's excellent. One of the things that I noticed throughout this COVID piece was just the focus from your organization around communication with all of your stakeholders, whether that was investors, your tenants, other stakeholders, I'm sure. So where does that come from? Like, how is that driven internally? Can you talk a little bit about that?
Yeah, I think our value propositions that we hold very dearly to our hearts, and this comes from our founder, CEO, Anthony Giuffre, is this honest communication, deliberate communication, and in it together. And as we, you know, started to embark on this journey with COVID, the one thing that I recall Anthony saying on like the first Saturday that this crisis started was, we need to up our game on communication. Be very, very deliberate and come at it with one voice, because our residents are going to be fearful, our employees are going to be fearful, and all of our stakeholders in terms of the capital markets are going to be fearful. And that was the precipice of our communication strategy. And really, at the end of the day, it was really for us to be transparent have honest, deliberate communication, and explain to all of our stakeholders, here's what we're doing. Because this was different than anything else that was out there at the time, and it continues to be different. So just that deliberate over communication has paid off a lot, because I think it allowed people to feel comfortable, and it allowed us to feel comfortable because we were just continuously being transparent and forthcoming with here's where we're at. And, being able to put KPIs up twice a month showing collections doesn't allow us to hide under any stones to say, well, we had a bad, no, we are very forthcoming with that. So it's very good from our side.
That's great. We have a question here. What is your unit price currently, and how is the distribution calculated?
So the unit price is currently $10, and the distribution is 60 cents per unit, or 6%. And we're hoping and anticipating that there will be a small upnode in the unit price here pretty shortly.
Gotcha. One of the objectives is your borrowing base. Can you talk about sort of how the debt side of your balance sheet is structured, and whether there are opportunities, improvements that you've made over the last couple of years on that side of the balance sheet?
Yeah. So, I mean, leverage ratio, first and foremost, was critical for us. We maintain a target of 60% or less. And within that leverage ratio, we have various sources of capital. So, for example, on a new asset acquisition where we're doing an asset plan, we typically borrow short, we create value, and then we upstream refinance for the longer term. We also have access to CMHC insurance. Our CMHC insured access has been growing steadily over the years. And we also have access to conventional bank debt. All in all, if you take all this debt and put it together, we're sub 4% in terms of our weighted average cost of capital. And as we are able to take on more and more CMHC debt in the future, as the assets stabilize and we're prepared to take the right leverage on there, there's a lot of room to bring those debt ratios down, because the current price of capital has gone down quite a bit.
That's great. We don't have any other questions at this point, Jason. We just had a question. What's the current loan to value ratio that the fund is operating at?
Yeah, so 60%.
60%, great. Okay, I think that's it for questions. Is there anything that you want to leave our viewers with in terms of messaging around the opportunities moving forward?
Yeah, I think what's really interesting is, we raise a lot of our capital, not just, geographically, locally here, but from out east and out west. And, we face the brunt of the headline risk when it comes to capital markets, whether that be raising equity or raising debt. I know, Peter, we've been on roadshows together where it's, always having this conversation about why the prairies, why oil and gas correlated markets. And at the end of the day, what I think we have seen and what COVID has proven out is that we have focused our business model on a subsection of society, or a subsection of assets that is fairly resilient and in a sense economically resilient, and does do counter-cyclical things during these times. And so what's really interesting and it's a proverb that I've heard in the US, is that, workforce housing in great times does okay, but in bad times it does great. And so what's really exciting for us now is that we're on the precipice of something big, where we're seeing the ability to continue to access capital because people have seen that our thesis has proven out, and the ability for us to go and continue to consolidate with the opportunity that a recession brings to us. So it's an interesting journey. And so we're just very thankful to the support that Raintree's awarded us, again, being one of our first investors in the Core Trust, and really just everything that you guys have done for us. If you have any questions, feel free to reach out.
That's great. Jason, thanks for your time today. I really appreciate it. Thanks for everyone attending. If you have further questions, please reach out to Raintree Private Wealth Advisor, and we thank you for your attendance today. Cheers.
Cheers.